Good morning and welcome to the Killik podcast for Friday the 26th of February. Another week where the oil price has been driving the bus for markets. So we've seen a very close correlation between the price of oil and equity markets and the treasury markets. So here we've got a little chart on looking at those relationships going a little bit further back. And as you can see, the weakness in equity markets and bond yields year to date has really been a closing of the gap between the oil price and those particular markets, and a realization that what's going on in the oil industry could impact the real economy. So we're really focused on this, and we'll get a lot of data next week to confirm or reassure that that is or isn't the case. So that'll be mapped around the ISM numbers, which are coming through next week in the US, and they predict the confidence from manufacturing and service industries about the next few months going forward. And as you can see here, we've got the two of those surveys mapped. They do tend to correlate very closely to one another, although we've seen this disconnect over the last couple of months in the service and the manufacturing index. As the oil price has fallen, industrial activity has reduced, but the service sectors continue to plough on. So at the moment, the market is chiefly worried about the slowdown in the industrial activity in the US impacting the wider service economy. So what we're looking for this week is a stabilization of that ISM manufacturing number, which we think we will have, and therefore that'll give reassurance about the ISM service number, and therefore about the US economy not falling into recession. We've had a further layer of complication with the Brexit referendum that was announced at the weekend. So 23rd of June will be the referendum date. As we can see, the chief reaction to that announcement was a sort of very big move in sterling against US dollar. We're also seeing more volatility. So we're now at a 7-year low against the US dollar and a lot of 5-year high in terms of volatility. Surprisingly, usually equity markets react negatively to that currency volatility, but the UK equity market has actually outperformed the European market this week. And that's by and large because we're seeing quite a lot of outflows from European equities at the moment. And I think people are now starting to focus on the potential dangers for Europe in the second half, whether it be a large Greek refinancing. The opinion polls for the core leaders, particularly Angela Merkel in Germany ahead of elections in France and Germany in 2017. So in terms of stocks and the impact of Brexit, we're looking at the businesses that are most sensitive to UK GDP, most sensitive to the currency, most sensitive to yields in the UK and credit spreads. So that's pulling up a number of stocks that potentially you might like to look at in terms of potential plays for us remaining in the EU going into that referendum date. Equally, we saw credit spreads and financials, which have been a key worry for markets, start to normalise over the week. Here we've got the Lloyds CDS, so the cost of insuring against a bond default in Lloyds. That's particularly helped by a very strong set of numbers in terms of the capital adequacy for Lloyds that came out this week, and quite a steep increase in their dividend yield. So they've raised the dividend yield to 2 3/4p, and the strong capital position and outlook on that has reinforced confidence that they can pay as much as 5p in 2017, which would be around an 8% yield. So looking at the week ahead, it's pretty busy. Monday we've got VW, Tuesday we've got Barclays, Taylor Wimpey, Glencore, Direct Line. Wednesday, no Killik & Co. List stocks. Thursday we've got Travis Perkins and Continental, and on Friday we've got WPP and Gemalto. Thanks for listening. Have a good weekend.